Good morning. Welcome to Oregon Cash Flow Pro. My name is James Barber, and I'm here to help you maximize your cash flow. Out here on the trail again this morning, doing our hike. There's Roku trailing behind us. Got the misses up ahead of us. And I wanted to share a few thoughts about bad policy design. Since our goal here is to maximize your cash flow, we try to do that and educate you on how you can do that in all aspects of our financial lives. I came across an especially egregious bad policy design this week that I wanted to share with you so that you can learn a little bit from it. I know the client who had this policy was really disappointed in its performance, and rightly so. And I'm going to show you why that's the case, and hopefully help you guys avoid something like this in the future. So let's get into it.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Now, when it comes to life insurance policies, they don't all have to be designed one specific way. Like, there's not a right design for you that's the exact same design for everybody else. We can acknowledge that. But there are some things that should never be a part of a design, and those are the things that we want to try to avoid. Now, in this case, we're talking about a universal life policy that a client brought to my attention. They had purchased it 5 years ago, and they were putting about $7,200 a year into this policy. We're 5 years into it, and they've got about $33,000 in payments they've made so far, because they're making monthly payments. So it's not quite 5 years. But they've put about $33,000, just over $33,000 into this policy so far. And so he wanted to evaluate it and see how it was doing. He saw some of my other videos on IULs, which you can see right here, and realized his policy is not doing what he would hope it would do. He wanted to get my opinion on it, just to verify. Now, we look at this policy, and it says the cash value in it right now, after 5 years, was about $11,500. So he's put in $33,000, and he's only got $11,500 in cash value. But how much of that is available to him should he need to access it? Zero. He had nothing available to borrow against. This carrier, when we look at the expenses in this policy, there was over $14,000 of administrative expenses in these first 5 years. And the surrender charges are astronomical. At year 5, right now, the surrender charge is still $19,000, which is why he has no cash value to borrow against. And if he wants to get out of this policy, he can't even do a 1035 exchange because there's no value to exchange. The cash surrender value is still $0. And it will likely be that way for at least another couple of years, assuming he keeps funding it at $7,200 a year. Now, that wasn't a max funding premium that he's been putting into it, which that's part of the issue. When it comes to universal life insurance and index universal life insurance and whole life insurance, the key to getting the most cash value growth out of these policies is to max fund them. You want to get in as much money as you can above the cost of insurance, because that's what's going to grow along with the index, or along with the dividend rate, or along with the interest rate if you're in a fixed interest account. So you've got to max fund these. The problem is the max funding for this particular policy was only slightly higher than what he was putting into it, just over $8,000. So I noticed this right off the bat, and alarm bells start going off. This is a terrible, terrible design of a policy. Part of what made it a terrible design is because customers and clients, they don't understand the lingo of the insurance industry. And actually, a lot of agents don't understand it either because they're too new. So often what happens is you, the client, will tell your agent, I want to put in X amount of dollars. In this case, he wanted to put in $600 a month. Well, you might think that's your goal. Your goal is $600 a month. And conveniently, our illustrations have something called a target premium. Well, usually when you want to reach a goal, you shoot for the target. And so a lot of agents get trained to design their policies to target premium. So if he says he wants $600 a month as his goal, they set that as the target premium. Well, that is not what target premium means in the life insurance industry. Target premium indicates how much commission the agents get paid. It has nothing to do with how your policy is going to perform or what your goals are in the policy. The only thing that has to do with how your policy is going to perform in the long run for cash growth is how much are you putting into it above the cost of the insurance. And when it comes to that target premium, if you're giving out 100%, 90 to 100% of a commission that first year of target premium to an agent, you're not going to have anything going to cash value. And starting off right out of the gate, your policy is going to underperform for the whole rest of its life. Now, that doesn't mean that 30 years down the road, if you started your policy and you funded it and you never looked at it, you wouldn't necessarily be happy. It's possible that the growth will outpace the cost of the policy eventually, and you'll end up with more money than you put into it, sometimes a significant amount, but oftentimes that is not the case. And where it really hurts people is in the early years when there's no cash value growth and you're socking away thousands of dollars. And if you encounter an emergency or a bump in the road to your financial success and you need access to some of those funds and they're not available, now it becomes a hindrance for you to have started that policy. We can avoid this with a proper design. With a properly designed policy, not only will it perform better in the early years, giving you access to the cash value, but it will also massively outperform in the long run, because the way that we design these is to minimize that insurance cost. And we design it so that when you say you want to put in $600 a month, that's not our target premium. That's our MEC limit. We want that to be the maximum or very close to the maximum that we can put into the policy, along with minimizing that cost of insurance. And in this case, you might think it was partially designed okay because it was close to the MEC limit. But that just simply wasn't the case because the costs were way too high. And what it looked like in this case, with a target premium of $7,000, that agent got about a $7,000 commission that first year. Pretty nice. Pretty nice commission for them with a client that's only putting in $7,200 a year. But that really hurts the client, in my opinion. And that's why I forcefully advocate against these types of policy designs. And I make it my job to educate you on how to identify a bad policy design. Now, some people, some other agents will point to that policy and say, see, this is why Universal Life is a terrible product. Nobody should ever own it. You should buy my product over here. And that's not really the case. Oftentimes, they'll show you their product. It'll perform a little bit better, but they'll design it just as bad. So even though it looks like an upgrade, it could still be a heck of a lot better. Most of these life insurance products, it doesn't come down to the actual product itself, but it comes down to product design. I would say probably 50% of it comes down to product design. 50%, you got to get in the right product. Those numbers may even be a little different. So it's really important that you know how to identify a well-designed policy, and you make sure that you're working with an agent that's going to design these policies in your best interest, not theirs. Because not all universal life insurance policies are bad. For the most part, it's going to depend on what your situation is for which product is going to meet your needs the best. Oh, hey, Roku, come on. Come on. Now, I don't tend to prefer the universal life product. There isn't very many situations where I find that that's the best product to meet any type of cash growth need. And my specialty in the life insurance industry is designing policies for maximum cash growth potential. Now that just happens to minimize agent's commission, maximizes the cash value available in year one. Hey. And the cash value that's available every year thereafter. What's the downside of a policy that's designed the way that I design them? Really, the downside comes from my end. The downside is that I get a very small commission compared to how much money a client wants to put into a policy. But the upside, the trade-off that I make, is that with this proper design, my clients actually see the benefits of putting larger amounts of money into these policies, because the benefit goes directly to them and not just to a salesperson, and not just to a salesperson trying to make a commission. So that's the trade-off. I showed this particular client a design how I would do it, putting $7,200 a year in, and if their goal is maximum cash growth, which, you know, it typically is, the only other option really is you go for a maximum death benefit. But oftentimes we can, if we design it for proper maximum cash growth, we'll get all the death benefit that we need. Now, in this policy that I designed for maximum cash growth, $7,200 a year. In the first year alone, this client can have $5,000 or $6,000 in cash value available, even after surrender charges. After 5 years, no contest. Massively outperforms this policy that he had. Not only is there cash value available from that first year that he can access, but by that 5th year, there's more cash value available than he's paid into the policy, even after the surrender charge that's still around. So with these properly designed policies, if for some reason you had an emergency, you have to close the policy, or you just want to walk away from it for whatever reason, if it's designed right, the penalty is not going to be very much compared to what you've put into it. In a poorly designed policy, the penalty is 100% of what you put into it. So that's the risk we're looking at here. I hope to educate you folks on how to identify a poorly designed policy and share it. Share it with your loved ones. Don't let them buy these policies. Don't let them get into these policies. There is almost no benefit. Almost no benefit. Basically, every dollar that this person was putting into that policy was only going to serve the death benefit that he was paying for. Now, if he happens to die, okay, it did its job. But you don't need to pay $33,000 and not have any of that available over the course of 5 years to get $1 million death benefit. You could get $1 million death benefit with term insurance for probably, you know, 500 bucks a year. Something in that range, 500, 700 bucks a year. Depends on your health rating and your age. But it's actually very, very inexpensive. So the underlying costs of these policies, which is term insurance, it should be nowhere close to $33,000 over 5 years. There shouldn't be $14,000 in administrative expenses. We'll go ahead and wrap this up for today. I'll be back with some other bad policy designs to look out for in some other products. But this one in particular was so egregious. I wanted to get this out and get you guys educated. Hopefully you and your friends and family will be able to utilize this information to avoid getting into that same type of situation. If you want to find out more about Index Universal Life policies, check out these videos right over here. And we'll see you next time.
Now go maximize your cash flow.